Time now for today's strategy session. The S&P 500 recovering most of its losses that it saw during the summer sell-off, but the rebound isn't being led by the Magnificent Seven. We've been talking a lot about this, but it's actually the other 493 stocks in the benchmark index that are now driving the market as earnings growth for those companies turn positive for the first time in 6 quarters. Here to discuss, we want to bring in JoAnne Feeney, Advisors Capital Management Partner, Portfolio Manager. It's great to have you, JoAnne. Let's talk about the outperformance of the 493. It's something we have been talking about for weeks here at Yahoo Finance. But I think the big question for investors looking ahead to that expected rate cut on Wednesday is ultimately what that means for that trade. What do you think?
Yeah, good morning. Well, we've all, for a while, were distracted by the big shiny object that was big tech. Really took off, obviously, over the last many quarters. And I think it snuck up on people how much of a move there has been in the other 493. And, as your show earlier displayed, the equal weight version of the S&P 500 has done a pretty good job recently because of those other companies. And that's been driven by their earnings. Their earnings growth has really improved over the last several quarters, again, turning in positive numbers for the last quarter. And that's really driven those stocks higher. And it does feed into this interest rate environment that you've been talking about this morning, too.
So what matters more moving forward then, earnings or the macro picture for the equal weighted S&P, for example?
Oh, that's a tough one. I have been saying, and our view here at Advisors Capital is you have to look at the fundamentals for the long-term value of stocks you put in your portfolio. Earnings are really going to be the big driver. So even though now we might be distracted by all the Fed speak, ultimately what companies can produce in terms of earnings really is going to drive their valuations. And even now, that's what we saw with those other 493. It's been earnings that have delivered for them, that have driven valuations higher. Now, of course, lower interest rates help reduce their cost of capital. And that's a positive thing for their earnings as well, because it allows them to do more investing and build more growth.
JoAnne, when you talk about the fact, or at least what an issue that I've brought up maybe over the last couple of weeks is the fact that we have seen estimates for the current quarter earnings lowered just a bit. Obviously, we're still expecting growth there. Is that at all worrisome to you, or how should investors then be looking at that, trying to figure out ultimately what that then translates into for leadership?
Yeah, certainly, Matt, we've seen earnings estimates come down a little bit for the rest of this year. But on the flip side, you've seen earnings estimates for 2025 move higher. And that's ultimately what's likely to drive stocks, from a period of the middle of September through the end of the year. It's going to be what can companies do for you in the future. So it's going to be less about what earnings estimates do this quarter and next quarter. And so it's positive that the earnings estimates have gone up for 2025. I think we're now for the S&P 500 somewhere around 14 or 15% earnings growth, which is really a strong environment. Not that there aren't risks that people really need to think about when positioning their portfolios, because obviously we have an election coming up, potentially different policy outcomes, but also just the geopolitical risks. And, the labor market clearly has been slowing, and there are some pockets that are downright weak. So these are all risks that, have to be taken into account.
And JoAnne, when you think about the election and something like the potential corporate tax rate proposed by the Harris camp, to what extent does that impact your view on small caps moving forward that have been sort of rallying as we head towards that rate cut decision on Wednesday? Do you think small caps are potentially at more risk of fiscal policy changes moving forward this year?
Yeah, I don't think so. I mean, obviously, the election at this point is a coin flip, right? We don't know who's going to win, and both sides have policies that, as an economist, I can tell you are pretty unattractive, particularly the tariff proposals that we're hearing. The corporate tax rate, it's low now. It's unlikely that both sides of the aisle would support an increase in the corporate tax rate no matter who gets elected. So I think that's a low risk situation. Tariff policy is more concerning, particularly for small businesses, because a lot of the time they're sourcing their inputs from abroad, and often from cheap suppliers abroad that are a lot of them in Southeast Asia. So that's a bigger concern for small businesses.
And when you think about that moving forward too, I know, for example, with your tech picks that you sent over to us, I'm really interested in the fact that you have Broadcom as one of your tech picks. And obviously, I'm not saying that Broadcom is a small cap, but it makes me think about kind of being defensive by not going with the most obvious name in the room, which in this case would be NVIDIA. Tell me about your choice on Broadcom there and what it tells us about your broader investing thesis.
In these kind of opportunities, Maddie, I like to highlight names that perhaps folks are a little bit less familiar with. Now, Broadcom has risen through the ranks through all the acquisitions that their leadership, Hock Tan, has made over the last several years. but it's still not as well known as, say, an NVIDIA or some of the other bigger guys like Microsoft and Amazon. We like all of those, by the way, and we think that each of those has a role in different kinds of strategies. So in our growth strategy, for example, NVIDIA is one of our top holdings, but so is Broadcom. And it's a little bit less well known. We like its mix of assets in terms of the software, the hardware, its leading role in some of the optical chip technology that it has had really since its founding back in 2005 when it first went public. So it's a core holding for us in almost, I think, all of our strategies here at Advisors Capital. At first, it had a great growth trajectory plus a really high dividend yield. The yield has come down a bit because of how much the stock price has gone up. So we consider that still to be a core holding. We think it's going to be good for the long term. Other companies like NVIDIA, maybe a little bit more volatile, but also a lot of growth ahead of it. So we like that one as well.
All right, JoAnne, we're going to have to leave it there, but really appreciate you joining us on all things S&P other than those top 7, except we got a little NVIDIA mention in at the end there, JoAnne. Thanks so much for joining us.